Hi, today we are talking about different types of assets. But before we talk about different types of asset, we need to define what exactly is asset. So asset is anything which puts money in your pocket, like rental income, stocks, or any business. There are 5 types of assets: securities, currencies, contracts, commodities, and real assets. In this video, we will briefly look about securities. But before we move ahead, smash the like button for the YouTube algorithm. Thanks. There are 3 types of securities: fixed income, equity, and pooled investments. First one is fixed income. As the name suggests, it gives you a constant return after each time period. There can be 3 types: long-term, short-term, and mid-term fixed income securities. These are typically debt instrument, which means the investment which you will buy is backed by some kind of debt or a loan. Next type of security is equity, which gives you a partial ownership in any business. There are 3 types: common stocks, preferred stocks, and warrants. The third type of security is pooled investment. As the name suggests, many investors can invest at once in these kind of securities, and the securities itself contains a lot of different types of, say, stocks or bonds. A lot of stocks are combined together, clubbed together to form these kind of investments. The examples being mutual funds, exchange traded funds, asset-backed securities, and hedge funds. Now we will look at equity and pooled investments at slightly greater detail, starting with equity. First type of equity is common stock. This is most common among individual investors like us. Generally, whenever we talk about trading stocks, we mean common stock. Buying this stock will give you part ownership in the company, as it's an equity, which means you will share the profit as well as the losses of that particular business. You will also get voting rights through which you can express your views to the management decisions. But be careful. If the company goes broke and had to shut off, common stockholders will be the last one to be paid. Then, who will be paid before common stockholders? The answer is preferred stockholders. This is less common among individual investors, although they also own a portion of the company or business, but they don't get a voting right. And it's more like fixed income security. Finally, warrants. They allow you to buy equity of a business or company at a later point in time. For those who know about derivatives, it's more like options. But those unfamiliar with the term, this is just an introductory video. So don't worry, we will cover everything in the subsequent videos. Subscribe and turn on the bell notification to stay tuned. Coming back to warrants. Again, they allow you to buy stocks of a business at a later point in time. You get the rights today, but they are not traded on stock exchanges and generally have a longer lifespan of around 10 to 15 years. This was equity. Now moving on to pooled investments. First is mutual funds, which is very common. Imagine it as a jar of candies that you can buy at a candy store. Experts fill each of these candy jars with different kind of candies. You might like some or might not like the others. Here, each candy represents a stock, bond, or any other type of asset. The candy jar is prepared by expert candy makers, who are called fund managers. And the market defines the price of each and every candy once in a day. That is, mutual funds are traded once in a working day. The second type of pooled investment is exchange traded funds or ETFs. This is again a type of candy jar similar to mutual funds, but generally tracks a market index like Nifty 50, Sensex, S&P 500, etc, 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 and are traded like common stocks throughout the trading hours. Third type of pooled investment is asset-backed securities or ABS. People take some loan against collateral assets like home loan against your house, car loan against your car, education loan, or credit card debt. If one fails to repay the loan back to the bank, then the bank will seize the car or the asset. Asset-backed securities are a bundle of such asset-backed loans which investors can buy. The assets do not include mortgage or real estate. Finally, the hedge fund. Simply defined, it is managed by highly specialized fund managers. They take money from large investors or sophisticated investors and deploy different complex strategies to maximize gains or profits and take a small percentage of profit as well as a management fee. Hope you got the flavor. Each topic in itself is quite vast and we will cover everything in coming videos. Let's summarize what we have discussed till now. There are 5 types of assets: securities, contracts, real assets, currencies, and commodities. In securities, there are 3 types of securities: fixed income, equity, and pooled investment. First, fixed income security, which provides fixed return over time period. The examples being treasury bonds, notes, or bills. Second one is equity, which gives you a part ownership in some company. This is further subdivided into common stock, preferred stock, and warrants. Finally, the pooled investment, which invests in a bundle of assets like mutual funds, exchange traded funds, asset-backed securities, and hedge funds. Hope you liked this video, and if you did, I would be very grateful if you smash the like button, subscribe to our channel, and hit the bell notification so that you know when we upload a new video. Thanks a lot. See you next time.